Welcome, my friends, to another edition of the Heritage Wealth Planning YouTube channel. Today, I'm going to take umbrage with Dave Ramsey, and I'm a big fan of Dave Ramsey. I like the fact on his debt planning stuff because I absolutely do think debt is a slave, or you are a slave to debt, and I think our society as a whole let me close this out, takes way too much debt for instant gratification. I'm just as much as a victim or as guilty as anybody else, so call me a hypocrite if you will. But at the end of the day, the fact that debt is free flowing and we can buy something today, even if we don't have the cash flow, I think it's endemic of the society we live on, which is instant gratification. It's not good. It keeps you enslaved to the master, what is debt. You can't just go on your own, start your own job. If you owe the student loans, if you owe your mortgage, you owe this, you owe that, you can't. And the interesting thing is, since I've been self-employed, it is liberating like you wouldn't believe. You can do what you want. Now, you got to find clients, you got to find income, you got to find all kinds of that stuff. But as you slowly build that, you're going to find it. You're going to find it. You live in America. Get out from the shackles that is debt and go start your own thing in your community, local community. Be part of the community. Offer your services, your experiences to people. They need to hear it. They need to see it. You're holding yourself back if you have all this debt. And so I love that about Dave Ramsey. I 100% agree with it. The idea to get rid of your debt is wonderful advice. You can put all day long on paper, oh my goodness, the stock market is 10%, my debt's 4, thus I should leverage and be in the stock market. You're getting 10 at the cost of 4. Insane. Don't do that. And Dave Ramsey not arguing that. Don't get me wrong. But just because it looks good on paper doesn't mean it is right. So I'm going to show you a YouTube video out here. Where Dave says, is $1 million enough to retire on? And the answer is it is, absolutely, for sure. But that's not what Dave was saying. And I'm just going to show you what I wrote in response to this is that Dave says if you got $1 million and the market averages, I think he was using 11.5, I don't know, let's just say 10% a year. And I just, oh my goodness, it's driving me up the wall. But if the market average is 10, we'll just say 10, he says you can pull $70,000 out a year without touching principal. He needs to know better than this. It boggles my mind. And what I've done here is I did a real quick. I said, if you're pulling out 7% a year, that's $70,000 on your portfolio. Now, let's say it's 2000, the market's dropped 9%. It's 2001, it dropped 11%. It's 2002, it dropped 22%. Now we're down to 458. In 3 years, we have half of what we put in there, even though we followed I'm not going to say Dave, but even though we followed the mathematics that you can get 10% a year in the market because it's done that since 1926. You're only pulling 7% out, and theoretically, you haven't touched principal. It's horrible advice. And Dave shouldn't even go down this road. He shouldn't. For the defenders of Dave Ramsey like I am, stuff like this is just what puts him in just the outhouse because it makes it hard to defend because this is bad advice. And Dave's too good of a guy for this. And it's frustrating. So anyway, in 2003, the markets were back up 28%. So now you're 458, which you started the year with, went to 595. But then you took $70,000 out. Now you're down to 525. In 2004, the markets were up 11%. Your 525 grew to 577. You took 70,000 out again, and you're back down to 507. Now remember, we're saying 70,000. We're not even accounting for inflation. The cost of goods are still going up. So if you need 70,000 a year in year one, you're going to need 70,000. What's that? Plus 2-3%. So 72,100 in year two, and so on and so on. I'm just saying a flat 70,000 a year. So now in 2007, the markets are up 6%. So now we had 466. We had 494 in 2007 after having 2003, 4, 5, 6, 5 straight up years. We had 5 straight up years after 2002. But because we're taking 70,000 a year out, we're left with 424 as we went into 2008. So we have 40% roughly of our portfolio left. We were able to take out 2001, 2, 3, 4, 5, 6. We've taken 7 years, 8. We've taken $560,000 out. So 8 years at 70,000 a pop. We've taken 560,000 out, but we're down to 424. And remember, we started with $1 million, 424 plus 560. So even if you factor in the additions of those 560 that we took out, on top of what we have left over, 425, we're still $16,000 short of the million we started with. And Dave insinuates that you can take 70,000 a year out, and he actually says it, without touching the principal. And in fact, that's the furthest thing from the truth. If you retire in 2001 and 2, now watch what happens in 2008. Market's down 37%, but you still need that 70,000 a year. So just before you take the 70,000 out, you look at your portfolio, it's down to 267, my friends. You pull 70,000 out, and now you're down to 197. You're done. You're doomed. Within a decade, you're out of money. $1 million within a decade, you've run out of money. Horrible, horrible advice. Anyone who's offering financial planning advice even insinuates without explicitly stating you can take that out is they need that. It drives me crazy because it's horrible advice. And let me show you some what Vanguard has this study on, because it's mixing average returns for the volatility of the market. And that's a rookie mistake. And Dave's not a rookie. He shouldn't make this mistake. It really ticks me off. I'm sorry. Here's Vanguard. When will we get back to average market returns? I've been looking for this white paper for a while. I had it like in 2014. Every now and again, I come across it again, and I can't believe I found it. I just found this today, and this even takes into consideration 2017. So I think Vanguard probably updates it every year. This is by far and away the most important paper on investing that you can absolutely read, by far and away. So here's what Vanguard says. The average return of the markets, and the use of the market is the S&P 500 going back to the modern era, 1926. The average return is 10.27. But returns fell within 2 percentage points of 10.27. That's 8.27 on the down and 12.27 on the up. They fell within 2 percentage points of 10.27, only 6 out of 92 years. 6 out of 92 years did the returns actually fall within basically a corridor of 8 to 12. I mean, what is that? Do you even tell us how much that is, what the percentage of that is? So let's just about 5%. Let's see. So we're going to take my trusty calculator here, and I'm going to say 6 divided by 92. That's 6.5% of the time. 6.5% of the time did the market actually give you within even a spitting distance of the average return of the market. And I don't even argue that's a pretty significant corridor there. That's pretty wide. And we're talking 8 to 12. So if the market returns average of 10%, and we're talking only 6% of the time was it even within 40% at 40% of that range of 10, because 12 and 8, that's 400 basis points. That's literally 6% of the time the market gave you within 40% of the average returns. It's absurdity on steroids. And yet people are insinuating you can take the 7, 8%, 5, 6%, and even add to your capital without even touching the principal. It pains me. It pains me. Plus or minus 2 percentage points, my friends. Look at that. There's that corridor right there, the gray, I guess, or light purple. There's the red at 10.27. I remember this very, very well. This is the late 90s. All right. Look at that. Boom. Nice and booming. Everyone's booming. Everything was good. This time was going to be different. Kaboom, kaboom, kaboom. As I just talked about, market goes up. I'm back. Kaboom. You're not getting anywhere near 7%, which is why we have the safe withdrawal rate, going back to the 4% rule with Bill Bengen, the Trinity study. Anyway, so you say, okay, what if we add bonds to the equation? Well, here it is, Vanguard. They give us a bond return. So the average bond return, what are they using for bonds? They're using SP high-grade corporate bonds from 1926 to 1968, Citigroup corporate from till 1972, and the Bloomberg Aggregate Bond Index since 2009. So basically the bond index, not just government bonds. They're using corporate and a bond index. I think that's fair. The average return of the bond index is 5.35. plus or minus 2 percentage points. So remember, 5.35 goes down to 3.35 and up to 7.35. We're talking, we're basically saying we're almost doubling the wide berth of the average return. And even then, the market, we're talking a huge corridor for average. And even then, was that 30% of the time did the bond market give you within, not the average, but within 4 percentage points of the average, 2 on the down, and 7 on the high. It's 3.35 on the down and 7.35 on the high. It's horrible. And here, let's go back. So that's 19. Let's see. Here we are in 1994. Market got crushed. Here we are in 1999. The market didn't get crushed, but because the bonds are supposed to be safe, everyone's like, oh my goodness, the bond market. Why did these things happen right there? Because Greenspan and the fellows in the Fed were raising because they were worried about stimulating the economy and having unprecedented growth is going to make inflation lead us to be like the Weimar Republic in Germany, or right now in Venezuela, where it takes you got to lop off zeros on the end of your currency. Silly, but that's what they thought. And so when they started raising rates, the bond market collapsed. Is right here. I don't even know that's collapsed. Like 3.5% is what it was down that year. But still, everyone and their mom were freaking out. That's when long-term capital management, too, because they did not anticipate all their algorithms, all the PhDs and Nobel Prize winners in economics. They could not they couldn't fix it in terms of what was coming down the pike that they had no clue about. Unintended consequences. Just ignorance, frankly. No one can predict the future. Their computer models certainly couldn't predict the future. And so we had an increase in interest rates on top of all the shenanigans going on in Russia at that point. It sank them and almost sank the whole entire investment market. Here's 2008. Now remember, I just want to point something out. 2008 was not bad for all bonds. 2008 was pretty good, actually quite good for government bonds. 2008 was bad for corporate bonds. Anything that was not guaranteed by the Feds got hammered. However, a government bond did quite well because everyone was fleeing towards safety. They said, I'm selling my stocks, I'm buying government debt. Selling stocks, selling corporate bonds, selling municipal bonds, I'm buying government debt to make sure I will have a guarantee, which is why you always want to have some government bonds in an overall portfolio to give you, not because it's going to give you a good rate of return, it's going to give you that safety measure when everything goes to hell in a handbasket, which is what happened there. All right, so let's just say we have 92 years, and I don't know if they did a combination. No, they didn't. But you got 25, let's say 30% average in the bond market within a huge berth, a huge corridor. 7 and 3, the average bond's 5. And only 30% of the time did it even get that. Stocks, 6% of the time. Quite a large berth there, too, between 8 and 12. And only 6% of the time did it actually get within spitting distance of the average of 10%. So going back to Dave Ramsey, taking 10% a year, we're expecting our portfolio to give us 10% a year, which is okay. I would challenge that. I say you're probably looking at 7 to 8 actually. But let's just say it's 10% for simplicity. And you're pulling off a percentage based on that number without taking into consideration volatility, which is what this is, up and down and up and down and up and down, up and down and down. You're going to be doomed. Don't let that be you. Don't let that be you. Don't let that be you. Cannot stress this enough. So I'll close up shop there. As always, give me a thumbs up. Put comments down below. For the love of all that is good, do not follow those rules. They're horrible. They're horrible, and you'll be doomed. You're going to be doomed if you follow that rule. And I just looking through the comments, I can't tell you how many people do. And Dave Ramsey should know better. All right. Hope this has been helpful to you. Don't forget to subscribe down below. And certainly hit the notifications, the little bell there so you can be notified of future content. Don't forget to go to the webpage at heritagewealthplanning.com. Sign up for my podcast. It's the Josh Scanlon Podcast. And give me some comments. Feedback always helps me, helps YouTube identify me to let this information out to the general population as a whole. So look forward to seeing you next time on the Heritage Wealth Planning YouTube channel. Thanks, guys.